All right, noted short seller Ben Axler, Spruce Point Capital Management, has revealed his next target, medical device company Stryker. Axler says the company has made questionable acquisitions and is being too aggressive with its accounting. He thinks the stock warrants a drop of 35% to 70%. Joining us now, and he first on Yahoo Finance, is in fact Ben Axler. Ben, good to see you this morning. Very interesting call, and three words really stood out to me off of your letter here: independent forensic investigators. What would you like independent forensic investigators to look into regarding Stryker right now?
Well, that's a great question. So I think we find a couple anomalies in the financial statements. Number one, it looks like the company has two sets of depreciation and amortization. There's one flowing through the cash flow statement, one set, and then there's another set flowing through the segment reporting. So that's not adding up. The acquisitions aren't adding up. They did a $1 billion plus acquisition of K2M Group, and the company marked up the acquired inventory at 100% of fair value. And then what we found in foreign financial statements was that Stryker's own auditor put a qualified opinion on $30 million of K2M's inventory. So qualified meaning they couldn't accurately count that inventory, but yet Stryker put 100% of that fair value and then runs non-cash costs through its income statement, which it would love investors to ignore. So those are a couple of the issues. But broadly speaking, we have a bigger issue with the company's business model. It's changing acquisition strategy, which we think is producing diminishing returns on investment, and the margin squeeze that's going on from years, deferred investment, supply chain mismanagement, and now rampant inflation. We think cash flow is going to decline, and investors that think this is a safe story in the healthcare space really need to understand that the company's products are elective. They've been deferred. They are being deferred. And this is not a place to be a safe haven stock as an investor.
Two things I want to quickly mention. Of course, we reached out to Stryker multiple times for comment on your report. They did not return Yahoo Finance's request for comment. And secondarily, Ben, this is your largest activist short selling campaign yet. Now, of course, I've followed your calls on Oatly and Tootsie Roll, but this is your largest yet. In terms of acquisitions, why do you think Stryker is making these bad acquisitions, and what makes them bad?
I think they're under pressure to grow. So they've diverted 60% of their cash flow over the past decade to acquisitions. And that was a smart strategy 10 years ago. They had surplus cash. They had no debt. Now the story's changed, okay? They have over $16 billion of adjusted debt. The cash flow is under pressure. The cash is about $1.5 billion, and the total leverage is about 5 times. They were recently downgraded by the credit agencies. And by the way, look at the debt values. Their debt is trading down 10% year to date. Their equity's flat. So there's a huge divergence between what the bondholders think and what the equity holders think. But now they're paying 10, 15 times revenue multiples for low quality acquisitions that aren't adding much operating income. They hide this from investors. You have to go to the proxy statement to see last year they spent almost $400 million and they got $1 million of EBIT contribution. That's what we call risky, unproven acquisitions that just aren't moving the needle and aren't adding value for shareholders.
Hey, Ben, it's Julie here. Talk to me also about the competitive environment. So Stryker, it makes products that compete with Zimmer Biomet, with Johnson & Johnson. And what does that competitive landscape look like?
It's terrible. So this is why you want to be short a company like Stryker in this environment. Their products are deflationary. They've been deflating, they say, at about 1% per annum. We think that's a little bit, it hides the fact that their core growth business, which is the Mako surgical product, which is the next generation robotic assisted surgeries, that product, they used to be getting $1.5 million for. Now competitors are giving it away at no upfront cost in exchange for commitments to buy the implants. And so the cash flow is under stress. The core products are deflating. And meanwhile, the supply chain, as we all know, it's a hot topic, inflation is ripping them. So they're caught in a margin squeeze where their revenues are under deflationary forces and their costs are under high inflation forces. So that's why we think the margins are under extreme pressure here.
Ben, one thing I did not see in your letter is calling out the CEO. Do you think the CEO needs to be canned?
Absolutely. I mean, I think, it's very clear now. So it's one thing to do bad acquisitions. But now they're engaging in what we call accounting shenanigans, and they're making changes to inventory accounting policies. They're stretching out depreciation periods. They're getting more aggressive with their tax position. They've stopped buybacks to preserve cash flow. They're doing things to obfuscate, we believe, the core financial pressures that the company's under. We point out that the CEO made a comment that, oh, our inventory turnovers are improving. But guess what? They reclassified loaner inventory from inventory to long-term assets. And so if you pro forma adjust these numbers, you'll see there's been no improvement in the inventory. But I really fault him for one thing. They've put sales and acquisitions ahead of cost rationalization. And that is coming to bite the company right now because supply chains are so messed up for them and their operational footprint is so large. They have 50 manufacturing facilities across the world that they were ill prepared for the pandemic. And now it's coming back to bite them. And they impaired an ERP project. They spent $500 million on that. But you wouldn't know it. The CEO got record compensation in 2021. So there's governance issues here. There's a huge misalignment between how shareholders are going to do and how management's doing. Management's doing great, but shareholders are not going to be doing great here coming forward.
Ben, have you talked to management?
We've not, but we have an open. I'll put an open communique if they'd like to contact me and rebut what we've said. They have an open mic. We look forward to them answering our top 5 questions, which we put in our report to explain, certain anomalies we're finding in acquisitions, why they have an impaired goodwill. Okay, they divested an asset they got zero cash for. They paid $300 million and they never impaired the goodwill. How is this possible? So why haven't they impaired goodwill? Why are they making inventory accounting changes? And ultimately, why is the cash flow under pressure and management not acknowledging it?
Lastly, Ben, how difficult has it been to be a short seller in this type of market where it very easily can rally off a low? I mean, clearly you've done your research here, but more broadly, how has it been for you the past year?
So we had a great year last year. I mean, look, you have to be very patient. You have to have high conviction in your research, and you have to believe that fundamentals will ultimately match up with the share price. I mean, last year, we saw the rise of a new class of retail investor that took control of the market. Things got disproportionate. We timed our shorts very well, and we laid out our thesis, and ultimately the public and the market, will decide if our thesis is correct. Stryker is a little bit of a different animal. It's a heavily institutionally owned stock. And we think institutions that are in it, again, are in it because it's perceived as defensive and it's done well. But that's the past. As equity investors, we're forward looking and the time has changed. Stryker's debt's too high. Their margins are being squeezed. The Stryker family has been selling stock and they increased their stock last year. And management is not behaving in a way that aligns them with shareholders. And we think these governance matters we're going to take up with Harvard Business School because the dean of Harvard Business School is on the compensation committees, on the audit committee. We think they need to set an example and set management straight here and hold them accountable for bad business decisions and aggressive accounting and financial presentation, which is hiding the real truth about what's going on with Stryker.
Well, again, we should mention we reached out multiple times to Stryker for comment on your report. They did not return Yahoo Finance request for comment. And of course, we invite the CEO of Stryker on to come here and rebut these claims. We'll leave it here for now. Ben Axler, Spruce Point Capital Management, founder and CIO. Thanks for joining us. We'll talk to you soon.